Welcome to Theo Trade. This is Don Kaufman. It's March 19th, 2018. Let's start with a look specifically at the SPX and some of today's fairly wild volatility in the broader market. Now, I'm starting with the SPX, even though the NASDAQ took the brunt of the hit today. I'm starting with the SPX simply because the SPX held the edge of the expected move this week. Now, for those of you that tuned into the weekend video, we talked about how the SPX was sitting right around a $45 expected move. And that means $45 higher and or $45 lower. All right, so there's your expected move in the SPX. In trade, just on Monday here, we came down below that and ultimately bounced right into, again, the edge of that expected move. Now, that's a starting place. And the reason I just mentioned and recapped a little bit of the expected move is if you go take a look specifically at the SPX today, here, now, go look at the March 23rd expected move. People, you don't see this too often, and it's one of the things that needs to really kind of be, absorbed by every trader. If you're going to be trading on an intraday basis, if you've got trades on, if you've got risk in this marketplace, you need to be aware that as we move forward in time, the expected move expanded. Now, another way I kind of want to elaborate upon this for just a moment, we're going to go into think back. And what think back is, it's just end of day data. Again, on the weekend update, I looked at it with you on March 17th, right? So I'm taking you back to the exact same expiration, and I want to show you the contrast here. What you saw this weekend was about a 14.63 vol and a $45 expected move. Now, we said on the weekend video, we expected the volatility to pick up coming towards the FOMC, right? The Fed, and we talked about Fed 2.0 with, Jerome Powell at the helm, and we have absolutely no idea what to anticipate. So we did anticipate the volatility picking up. But this is strange because as you move forward in time, people typically think of options decaying, right? So as you move forward in time, the options decay. How does that occur? Well, time moves forward. In this particular case, yes, time moved forward, but volatility went up. So instead of the options decaying, go take a look at the option chain right now. Yeah, we jumped from like a 14 vol to almost a 23 vol. We now have a $55 expected move. Why is that crazy? Because the marketplace already moved 40. So you have to think of this as there's another $55 of movement that is being implied, okay, as this week moves forward. All right. And that, people, that should actually shake you up a little bit. Now, as I said, really a lot of people have their focus, of course, into Facebook. So some of the Facebook news is being blamed for the heavy sell side activity inside of the NASDAQ. But here, let's not point fingers towards Facebook because Google really had a large pull down in the NASDAQ. Speaking of the NASDAQ, and again, when you're starting to look at like Facebook and Apple and Amazon, all right, and Microsoft, the opportunities to me right now are simply to sit back and to watch a few of those underlyings at this point in time. Like, I'm not going to jump in. Listen, I have short positions right now inside of Netflix. Okay, many of you, if you follow these videos, if you follow Theo Trade and what we're doing and some of the emails that we send out with trades in them, you'll know that we have short positions here in Netflix. We have short positions inside specifically of Amazon, okay? And these short positions now are starting to play out, right? So I've got short positions that are in the money here in terms of Amazon, but I'm not looking for immediate opportunities in these underlyings. I'm looking to take off profitable trades in Netflix, profitable trades possibly in Amazon. Okay. In fact, I took off a profitable trade in Tesla. Talked about that this weekend. We had a profitable trade that was on the dance floor in Tesla. Well, we removed that today. All right. And we went out, we had sold a call spread. And that was one of the videos last week, the 375, 380 call spread. People, that trade was, over a month out in time. And here we are again, a week later, the market, Tesla comes down hard and fast. we covered the spread. So right now, you had to be kind of positioned for this move because this one caught many of us off guard. Again, I'm going to show you some opportunities here momentarily, but again, we took off profitable trade in Tesla. We're looking for an exit profitably in Netflix, looking for an exit profitably inside of Amazon. One of the things, though, that I want to remind you that I also talked about in a recent video was the expanded margin requirement for the NASDAQ futures. For those of you that remember this, the NASDAQ futures are now looking at a $7,700 margin requirement, which is indicative of over a 380-point move in the NASDAQ. Well, we didn't quite get a 300-point move in the NASDAQ, but again, just about a week ago, we warned of increased margin requirement means definitively that the exchanges and the regulators themselves feel that risk is upon us, and you're seeing just that. Okay, over a 200-point range inside of the NASDAQ futures. They're down another 30, but I want to point out, I say they're down another 30. The marketplace sold off hard and fast. The NASDAQ futures getting all the way down to 68.21. And if you zoom into this very carefully, and you'll see this is the cash close is right here. The NASDAQ futures, after the cash close, took off to the upside. Okay, and you got, again, if you take a quick glance from anywhere from 68.90 right up to about 68 or 69, I apologize, 69.15, a nice move after hours. All we're doing at this point in time is bleeding back this move. We're just bleeding back the move, and we're pretty much coming right even with where we are at the cash close. Now, all of this is great, but you want to know, where am I going? What are we thinking here? Okay, and specifically, how can I position myself for this move? For that, let's go to the S&P futures. Okay, let's look at the S&P futures. Now, you're not going to be surprised by this. I'm a little bit bearish right now. I've been bearish for quite some time, right? No pun intended. I have been bearish for quite some time. One of the levels I would look for specifically inside of the S&Ps. And hey, listen, this one, it's worth writing down. And you should notate this. The line that you see on the screen is 2682. Mark it, because if the S&Ps come off hard and fast, they're going to stop cold at 2682. Now, I'm going to also caution you, if we come down to this 2682, okay, and we happen to cross through it, people, it's a free fall drop. At that point, you're talking like, again, 2,500, and that's really, and kind of zoom out for just a second, then we start talking about really retesting some of the lows from back in early February. But I would expect us, people are all into stop orders. You don't need a stop order over here. There's a concentric area of risk right around 2682. If we come down into 2682, we're probably going to stop there for a period of time channel. Okay, if we blow through it, volume would absolutely explode inside of the S&P futures, and we could be off to the races. So there could be, okay, the chance for some heavy sell side activity. But again, I'm predicating that on the fact that we would have to cross through and quickly cross through this 2682. A lot of you are probably, where does this level come from? Again, if you back up in time just a little bit and you look back over the last 30 days, this has been an absolute key level where we've actually bounced from a number of times. As I said, this is not necessarily like a support and resistance. It's where some very large trading firms apparently have a tremendous amount of risk, which defines and why the volume explodes, okay, when we cross through it. You can even go back. So I'm on a 30-day 1 hour. For those of you that are a little bit more technically oriented, you can go into a 90-day. Go to a 90-day and play around with the idea of maybe like a 2 hour, hit OK, kind of zoom out in time a little bit. If you think this level isn't important, again, we actually traded in and around this level a number of times. And you can even see in the midst of some of the most wild volatility, okay, we stopped there on a dime, hung out there for a while. In the midst of a spectacular rally to the upside, we stopped there, channeled in and around this level, exploded above it, pulled back into it, exploded above it, okay, used it for a top, used it for a bottom over here, whatever you want to call it. But I'm telling you, if we do crack through this 2682, you got nothing but downside risk, and that's retesting some of the February lows. Now, in addition to that, so that's kind of, where we're going over here. In addition to that, you got to be a little careful coming into the next couple of trading days. Why? Well, it was only last week that we talked about the volatility futures. They backed off. They actually cruised back into what we call contango. Well, guess what? Now they're back in backwardation, which means quite definitively, okay, seat back in the upright and locked position, because we're going to rock now. So I want you to take a look exactly where these volatility futures stand. We are ever so slightly into a backwardation. What that means is that the April volatility is slightly above the May volatility, which is slightly above, again, the June. So last week, the volatility looked like this, all right? That is the short end. This is the 30-day. And the 30-day was sitting closer to like 17. You go a little further out in time, these monkeys would be 1780, a little further out in time. You're talking about like 1830. And that's kind of what the volatility looked like last week. Right now, what does the volatility look like? Looks like this, where the 30-day, okay, is at 1785. And again, here we are at 1785, and then it actually drops off over time. And what that means is the risk is here. The risk is now. The risk is more prevalent, okay, in the next 30 days, and the risk is higher in the next 30 days than it is, for instance, 93 days out. And that people should really gain some attention. In addition to it, if it was just one thing, I really wouldn't care, right? But in addition to it, you got to actually back away and you got to look at the VVIX, the volatility of the volatility index. And what do you see in here? Well, it's north of 110 again. North of 110 means get under your desk and start rocking back and forth, because there's some volatility to come. All right. Now, how do you position yourself in a couple of individual underlyings? First, let me start with ExxonMobil. Whether it's ExxonMobil or the energy sector itself, the energy sector happens to be XLE. I'm actually looking, okay, for a short-term bullish position in here. Short-term bullish position in XLE or XOM, wherever I can get filled at a better price. Why? Okay, energy is going to come in the crosshairs the remainder of this week. Why? Saudi Prince is here. I would expect some bullish comments to come out of energy. And again, energy has been, well, here, let's go look at ExxonMobil year to date. Absolutely taken to the slaughterhouse thus far year to date. ExxonMobil is down 12.8%. You even got to look, hey, can they get the old CEO back? Because he got canned from his previous job. Just kidding. I don't think that's going to happen. Nevertheless, it's kind of fun and amusing to toy around with. So their former CEO is out of the job. But whatever you're comfortable in, whether it's XLE or XOM, XLE, of course, is the energy sector itself, down just about 10%. The other trade I'm looking for, so I'm looking for a bullish position on an in-out spread on XLE or XOM. The other trade I'm looking for, let's see if Boeing can bounce in the next day or two. Okay, Boeing. Now, I have been really traded this thing heavily. Right now, I'm out of all of my bearish positions inside of Boeing. I rode Boeing down, worked extremely well, helped me out, because last week had some sell side activity and my options were expiring last week. So we got out of that with a breath of fresh air, some fresh air, and I'm allowing this thing to kind of breathe a little bit, possibly bounce back to the upside. If it bounces to the upside, I'm going to do it again. I'm actually going to look for a short position inside of Boeing, because I think any bounce inside of Boeing would be a rather temporary bounce. All right, so again, I want to reiterate, we pulled off a number of profitable trades, have a number of other profitable trades on the dance floor. Tesla has been pulled off. I also happen to pull off a Spider Iron Condor. Okay, this is the first time that I can remember in years. I don't have any positions currently in the Spiders right now. It has been years since I've not had positions in the Spiders, but we're totally blanked out. Pulled off an Iron Condor that I put on all the way back in February for a nice amount of profit in that one. It was kind of a duration Iron Condor for those of you that remember it. Again, we pulled off the Tesla trade. Right on the dance floor is Amazon and Netflix, looking to take positions in ExxonMobil and Boeing in the near future. Thanks everybody here for joining us at Theo Trade. Have a wonderful evening. Bye-bye.